You got it, Ben? You ready?
Yeah, let's get it.
Hello, everyone, and welcome to the show. My name is Chris Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it.
All right, everyone. Welcome back to the Amateur Investors Podcast. Chris and I are here as always, but with us, we have a very special guest. He is a software development engineer at Amazon with a degree from Cornell. His background is engineering. He's got a wealth of knowledge in Bitcoin. We're really, really excited to have you here. The Stacker of Sats, Jimmy McManus. Jimmy, give us a little bit about yourself. We'd love to hear a little bit about your story and how you've got really introduced into Bitcoin, and you're really active in the community. I've already learned a ton just from us exchanging texts and calls. But yeah, the floor is yours.
For sure. So thank you, Ben and Chris, for having me on the pod.
Thanks for being here.
Yeah, thanks for being here.
First ever podcast appearance, so I hope I'm up to par. But
you got to start somewhere.
Thank you. Yeah. So Ben, you and I were freshman roommates, kind of. We were across the hall. We rode together at Cornell, studied information science there. So similar to computer science, but a lot of additional like network effects stuff, which was really cool, and like information systems. So just a little bit of a broader scope, which I think prepared me pretty well for kind of trying to like understand Bitcoin and be super interested in it. And my first real introduction to Bitcoin was, so my brother, he's been talking to me about Bitcoin for like 4 or 5 years now. Just like always, I thought it was kind of, crazy. But I'm moving to a new apartment in Denver, and I want a bike because I'm going to bike to work. And he has like a really nice bike. He wants to buy a new one, but this is a super nice one he bought in high school, and he wants to sell it to me, but he won't accept dollars for the bike. I need to pay him in Bitcoin. So that was the first introduction. I needed to download the Cash App. I needed to hook it up to my bank account, buy some Satoshis in order to pay him whatever it was, a couple $100 for his bike. I was trying to like time the payments so that like I could keep some of what I had put in and like pay him less.
Early arbitrage.
Yeah, I was trying to arbitrage the used bike purchase. But yeah, that was my first investment. And then he, set me on, he gave me like a good book to read, The Bitcoin Standard.
Yep.
Probably the best book on the subject. And then Inventing Bitcoin is like the Bitcoin Standard. It's more about like the monetary economic history and how Bitcoin plays into that. That Inventing Bitcoin is another great book on the technology, and like just like it's only 100 pages, super bare bones, no technology like knowledge required. And between those two, and then just starting to read more and more, I was super interested. I dove deep down the rabbit hole. Like at this point, I've listened to hundreds of hours of podcasts, and I've read the white paper, I've read articles, I've been on Twitter. The Bitcoin Twitter is out of control. So
it's a pretty crazy place, Bitcoin Twitter. I've been on it, a lot of it right now. I have not read the Bitcoin Standard. I kind of got really into Bitcoin in more of like June of 2020. So I'm a little bit further behind you. I know Ben and I are kind of on that same boat, but we're trying to catch up.
Yeah, similar to rowing and my knowledge of Bitcoin, to say that I rode with Jimmy would be akin to saying that that Dogecoin is the equivalent to Bitcoin. Jimmy is very, very fast and very, very intelligent when it comes to the topic of Bitcoin. So Jimmy, first of all, maybe we do an episode one day where we do sort of like a book review on the Bitcoin Standard. I mean, maybe that's a future episode topic. Yep. So shameless plug for you getting back here. So I think with all of the research that you've done, clearly well read, but I think what was sort of the clicking point? Like, where did you find that you found this new religion of Bitcoin? Why is Bitcoin so important to you? And where did things start clicking in terms of both investment strategy and a personal research project?
Yeah, so I mean, the why I'm so like passionate about it definitely has to do with like the study of Austrian economics and like sound monetary theory. So basically, like the fiat currency, and fiat is Latin for by decree. It's like the government's decree that this currency has value, even though it's not backed by any sort of commodity like gold. And for millennia, gold was the money of choice selected by the free market, right? And that kind of like, it's very scarce. The supply does not change very much, and the capitalism and market prices and market dynamics play off of that sound base where the unit that you're measuring everything doesn't get debased. And if you look back through history, like the Roman Empire started clipping coins, and and then everything kind of started to collapse, and the soldiers wouldn't fight for them anymore because the coins were clipped. And if you just look at all the negative effects that have kind of happened, there's been a lot of good things. Fiat currency kind of we pulled the future into the present. We pulled like future innovation, and we're able to fund a lot of things, but it is like discounting the future, or discounting, putting the present at a higher value than the future. And that's the concept of time preference. And that's like a big topic in the Bitcoin standard. And it's just like, do you guys know about the marshmallow test?
No, I haven't heard of this.
So in like, I think it was like 1935 or 1975, a Stanford researcher did a test with like, it wasn't a super large, not super statistically valid, but very interesting results. So it was like 30 kids, like age like 5 to 10 approximately. And he puts them in a room, he sits them down, and he says, listen, I'm going to leave a marshmallow on the table in front of you. And if I'm going to leave the room, and if I come back in 10 minutes, you get 2 marshmallows if the marshmallow is still there. And that he did that, and half the kids ate the marshmallow, half the kids didn't, half the kids got their 2 marshmallows. And then he followed back with them like 20 years later. So all these kids had gone to college, they had their first job, and he studied them based on like all these different criteria, such as like the level of achievement that they reached in education, their SAT scores, their body mass index, income rates and stuff. And the kids that didn't eat the marshmallow, the kids that were able to delay their gratification, that had a low time preference, they were doing way better on basically every single metric. And so that kind of is super interesting when you think about like the way that the currency currently works. If you saving currency would be having a low time preference, right? You like did a bunch of hard work, you're going to save money in the bank, and you're going to use it at a later date when you need it, if there's like an emergency, or like if you see a really good opportunity to grow your money in some way. But with the currency being debased at such a fast rate, you don't get to have that option for you. You kind of need to figure out a way to always grow your money, or just like, why not spend your money? Why not buy those like rims on your car or that nice watch or whatever? Because the like money doesn't mean anything. Cash is trash. And so those kinds of like undercurrent effects that like the fiat currency has, I feel like, on society, like everything is financialized. Like the financial sector has become a larger and larger section of the GDP. And you could say that like, they're making sure that capital goes to the right areas, and that's providing a good for society. And maybe I buy that to a certain extent, but also like fundamentally all they're doing is moving money around. They're not actually creating anything more. They're not making the pie bigger for everyone. And you can't just save your money. You need to pay a financial advisor. You either need to spend hours and hours reading about stuff like this, like I have, or you need to pay a financial advisor to manage your money for you. And those people, they get a fee regardless of if they do well or not. And it's just a system that I feel like the little guy can never get ahead. You're constantly running on a treadmill and you just can't get ahead. And that really kind of like sits with me and is a little bit of why I think Bitcoin could not fix everything. On Bitcoin Twitter, there's the memes, Bitcoin fixes this, and they apply it to everything, every little thing in the entire world. And it's like, Bitcoin doesn't fix everything ultimately. But I think it could be good as kind of like keep the central banks honest. If governments want to debase their currency and the faster and faster and faster to try to solve all these problems, then Bitcoin will be kind of a measuring stick where every single person, anyone who has access to the internet, anyone who has access to a smartphone, and like, unfortunately not everyone does have access to a smartphone, but there are more smartphones than people in the world. So that I think that's that problem's gonna be solved. They can opt out. They can choose to store their wealth in Bitcoin, in this asset that can't be debased. And it kind of gives them a chance to just save their money and not have to invest in the traditional sense.
I think that the silent theft that is called inflation is something that is definitely under the radar for most people. I think it's similar to how people sort of disregard taxes until April 15th. Every time you make a sale on an asset, you're going to get capital gains tax or short-term capital gains tax, which is income tax. The inflation rate, talking about the debasement for folks that aren't familiar with that term, that's essentially just the money printing that's happening to inject fiat into the system in one way or another, whether it's the buying of assets on the Fed's balance sheet, or it's literally checks written out to Americans. And obviously, those checks are not getting to alive people all the time. Not everyone that's getting the check needs it. So yeah, as that money is literally changing in value every second, all you're left to do is just trust that when you go to, Walmart, Target, that they're going to accept that money for face value. And it is hard to control inflation on a money that's kind of fake.
Yeah. I know, I'm trying to do a calculation of figuring out what the real inflation rate is. It's kind of a complex problem. I'm trying to work for that right now for the amateur investors. But obviously, the government has incentives. They have a thing called CPI, or Consumer Price Index, as we keep mentioning on this. And it's in their best interest to keep inflation low, because if 1 year inflation were to go to 10, 15, 20%, or at least that's what they would report with CPI, that means that the bonds that they sold, or TIPS, Treasury inflation protected securities, it's something that the United States government sells, they would have to pay the difference on, if it went from 2.5 to all of a sudden to 15, that means that they'd be missing 12.5% of that inflation protected money that they had. And I remember my one history teacher was always telling me in high school, like, the government has no money. If you think about the government as a whole, they have $0. It's taxpayer money. So at the end of the day, either they can collect more in taxes to pay back that inflation that occurred, or they would just have to print money. Either way is not really good. On one end, people would be furious if they had to pay an additional 12.5% in taxes. I'm sure people in California, New Jersey, and New York that traditionally pay really high taxes would be furious. And states that have much lower taxes would be furious that they're paying a lot in taxes relative to what they were paying as well. So the alternative is printing money. But then getting back to exactly what you're saying, Jimmy, and you as well, Ben, that currency is now worth that much less. So I'm trying to use a couple different indicators using the Chapwood Index. I know there's been some debate about that's not always the best thing. Ben and I actually were talking the other day and saying inflation's relative to person. The best inflation is what you do. So, I mean, I live in my parents' basement right now. So my inflation for cost of living is not really calculated, at least for this year. I used to live in Morristown, but with the pandemic, I moved back home. But inflation changes based on your circumstances. If you're living in Beverly Hills versus if you're living in Texas versus if you're living in North Dakota versus, what kind of car you drive versus what kind of product you use for meat that you get for dinner for your family. It all is all relative, and it's all relative based on location and stuff. But yeah, it's some very interesting points there, Jimmy.
That brings up like a super important point. So you guys talked about like kind of how like the rich benefit from inflation more than the poor a little bit on your last two conversations about Bitcoin. And as soon as I was listening to that, the Cantillon effect. So that has a definition. I don't know if Richard Cantillon, or the first name's probably not right, but he came up with this in the 20th century. And it refers to the change in relative prices resulting from a change in the money supply. And so the relative prices, it means the prices that someone who gets the money first versus someone who gets the newly printed money last. So there is an injection point for that newly printed money. There always is. There has to be. And you mentioned, Ben, like the bailouts versus the UBI, the directly to the consumer. And UBI is much better, in my opinion. If the government's going to print money, give it to the people at the bottom all day long.
Yeah,
right?
I agree.
But that's
trickle-down
really,
economics doesn't work. So yeah, I
no,
completely
it's
agree.
bullshit. But for the past, since 2008, the majority of what they've been doing in the trillions of dollars of levels, they have been doing QE, and that's when the Federal Reserve trades reserve notes to the banks, and the banks then have higher reserves, which they can do more fractional reserve lending, and the people who get the money are the people that have super high credit scores that don't really need it, and the only thing that they do with their money is invest in assets, in retirement assets, in bonds, in stocks, in real estate. And if you look at the inflation rate on all of those on in assets, that is the inflation rate for like someone who already has their basic needs covered, and all they're trying to do is prepare for retirement. You mentioned inflation is very personal, and for the lower populace that is living paycheck to paycheck, they absolutely are looking at like groceries and gas and all those things. But everyone wants a retirement. And it just becomes faster and faster out of reach for so many people because the money just gets injected at the top. Assets go through the roof. That's what we've seen with the K-shaped recovery in this pandemic. You saw the stock market went down drastically, lost what it was at 30 or 40% in March and April of last year. And then now the economy is still in the tank. Like small businesses are closing all over the place, and it's just really bad for a lot of people. The unemployment like kind of rebounded, but it's more of like a square root sign than it is a V. And it's really bad for a lot of people. But the stock market's hitting on new highs every single day, and every single time they announce another 1.9 trillion stimulus. And I'm glad that they're doing the unemployment benefits and the UBI, more the UBI than the unemployment benefits, but I'm glad about both. And it's just, but most of that money is still going to bailing out different sectors. And like for every dollar that Main Street gets, Wall Street gets $8 or whatever the stats are. And it's different for every stimulus bill, but that's generous for most of them, honestly. So
yeah,
that's a really important problem.
No, yeah, and it's crazy too. Just the whole everything that's going on. And someone was saying I'm looking to get into rental properties and real estate. I know we've mentioned it a couple times on our podcast. And one of the things that's really interesting is that one of the main reasons, aside from investing in real estate, it's an asset, people pay you like passive income. But another big reason for it is basically you're inflating away your debt. So if you can, we always talk about leverage also meaning debt. If I can put down, let's just use easy numbers, a house for $100,000 and I put down only $10,000. Well, so now I own this property, but I have $90,000 on a liability side of my balance sheet that I owe. But if they're inflating away debt because the money is, they're printing money and, we know just talking about scarcity, as there's more and more money in the system, things go up in value relative to how much money there is. But that really means that money got less valuable. So, if all of a sudden a salary of $1 million, it buys you what in 2021 right now is $100,000, that means that house, the inflation inflated the price of the house so that the house is going to go up in value. But also I deflated away my debt because as we're assuming you're getting raises or new jobs or acquiring different ways, you're getting more money, but the asset that you put into the debt that you had outstanding on it is like pennies on the dollar because it's inflated away. I know that's like kind of a hard concept to rationalize, but imagine buying a loaf of bread in, the 1930s or whatever for 10 cents or a nickel. And now like a loaf of bread's like $2-3. So like just shows the wealth disparity and going along to even what you were saying, it hurts the middle and lower class even more. And even as time goes on, there's more of just lower class and high class and upper class or the wealthy, in the sense that, a 30 cents increase in a gas tax is not going to hurt, Jeff Bezos, Warren Buffett, whatever, from like putting gas in their car. But if you're saying, gas right now is 250 and it goes up 30 cents, I don't know the quick numbers, that's more than a 10% it's more than a 10% increase on it. So that hurts the people that make less money a lot more, because that's a 10% increase in something they need to go to their job or do whatever, that like it's hard for them to keep up, because that's an expense they're not looking at. It's kind of like going along with Ben was saying, inflation's kind of like a silent thief.
Yeah, it's an accelerated divergence, and like
Yep.
it makes sense when you think about it, right? Like what Jimmy was saying about the upper class, or at least folks who have their basic needs covered. We'll call it that class, the class that is able to cover their basic needs and then invest the excess. Folks are, I mean, they're seeking yield everywhere they can. Folks don't want to make 0.03% in their high yield savings account, because that's what my investor checking is. High yield, great. So you have these folks who have to cover their basic needs, but you have the class that can cover their basic needs. They're able to invest in these assets that are just inflating away exorbitantly high to just exponentiated rates, while the folks who have to make their basic needs can't invest. Their wages are not inflating away. If you were to compare the rate with which the stock market is growing, and you compare it to the the minimum wage and just like the average wages for Americans and probably folks across the globe, they are not in lockstep. So that divergence really only exponentiates itself. And it is sad that you are forced to invest your money, like you said, Jimmy. There's no choice. You either depreciate away or inflate away, or you're looking to buy something at just disgusting price levels. Chris and I always talk about this, that the fiscal economy is a very different place than the real economy right now.
Yep.
You don't have record high stock numbers, and then also have record unemployment. It's a little contrarian.
Yeah. So, Ben, do you want to ask him the next question, I think?
Yeah, we'll just jump right in. I think we really covered that there is a fundamental flaw in the basis of our fiat money. Like you said, there is a tremendous benefit of having fiat money to a degree, but there are its limitations. And what we've seen, just the rapid debasement of our fiat, in at least from a US perspective, with like a total degradation of the money that we currently use in terms of trust and also value. At least that's the pessimistic lens that I'm taking. Where do you see us in the life cycle of Bitcoin's global adoption? I mean, when comparing fiat money that is being debased, you're losing your buying power every day to some degree. Bitcoin is very clearly the next best alternative. I mean, to have scarcity and to have a consistent measurement of your buying power, and to not necessitate the need to invest your money and lock it up in illiquid assets. Where do you think we are in Bitcoin's global adoption? I think there's so many benefits to be said about it. But what do you think the steps are to get to a Bitcoin global adoption? I think first, obviously, it's a value preservation. That's where we're starting, is savings accounts versus Bitcoin. So the floor is yours.
Absolutely. So I do think that there's kind of an order of operations in the way that like a good would be monetized, and most of my thinking on this subject is heavily influenced by Nick Szabo. He invented BitGold, and he was in touch with Satoshi Nakamoto, and Satoshi Nakamoto used some of his work in the actual construction of the Bitcoin protocol. And he wrote an essay called Shelling Out on the Origins of Money, and it studies how money originated as collectibles, like cool looking shells or like family heirlooms, and then it ultimately grows to be something that you can store your value in, something that others will value in the future, and that you can hold on to this thing, and it'll be more and more valuable, or at least the same level of valuable over time. And then ultimately it becomes a medium of exchange if it's able to be traded broadly and widely, and everyone accepts it as a medium of exchange. It's not just a store of value. And once it's broadly and widely accepted as a medium of exchange, it's a unit of account. And that means it's the fundamental baseline which all economic calculations are made under. And that right now is the US dollar. It used to be gold in the golden age of the Renaissance era. It was you could all the different currencies in Europe. There was different currencies for every country, but they were all directly convertible to gold. So you could make economic calculations all the way across, like cross borders, just using gold as your unit of account. And right now, where I think that Bitcoin is, I think it's moved past the collectible stage. You know, when it first started, only like supercomputer nerds like me, or like hardcore libertarians, or like Austrian economists, like people that were deep in the weeds on this stuff, thought it might be valuable. Yeah, or you know, buying fake IDs or drugs on the Silk Road. So those people, as a collectible, it was pretty cool. You know, there's only going to ever be 21 million, and that's the key point. There's only going to be ever 21 million. That's what makes it different than a fiat currency or anything. It has a hard supply cap. That was the collectible stage. I think we're past that now. I think we're moving into the early innings of the store of value stage. And the store of value potential market cap, you know, if we're just looking at gold, market cap, which historically has served that like store of value against government debasement. Ray Dalio is a big proponent of having at least 5% of gold in your portfolio. That would be $9 trillion market cap. There's something to be said for separating investment level gold with central bank gold that's held in the vaults, which is like about $2 and $7 trillion separately. But regardless, Bitcoin's right now is a market cap of, I mean, we're dipping right now pretty hardcore. We just went below 30. But I expect to be back above that by the time this episode airs. But around 600 billion. 600 billion is the market cap right now, give or take. And that's, you know, very, very low levels of that store of value aspect. So I expect it, like if every single institution in the world put 1% of their assets in this, then it would be at $100,000 per Bitcoin, potentially more. We're still just like that narrative of gold 2.0, digital gold. That is what's fueling the adoption right now, and that's why people are interested. If it eventually becomes a widespread store of value, pretty much everyone's like, yeah, Bitcoin, it holds its value or it goes up, and we all have a little bit, and we all like can access it on our Cash App or whatever it is on our phones. That technology gets better. More and more people know about it. It's not this crazy thing that just appears in the headlines once every 4 years. The value will stabilize, and it won't be doing these crazy volatility. That's all you hear about with Bitcoin is the volatility. And the returns are great when adjusted for volatility. It has the highest Sharpe ratio, which is the risk measured in volatility. Return, highest Sharpe rate, or the return over the risk, highest Sharpe ratio of any asset. But that'll eventually go down. So the volatility is much, much lower, and it just kind of inches up. As more and more people kind of like get on, it just kind of inches up. There's none of these crazy dips or crazy spikes anymore. And that's when it's fully capable of being a medium of exchange. You know, you don't want to accept your paycheck entirely in Bitcoin right now, because tomorrow it could be worth 50% of what you got paid, you know, and that's not good for anybody. And you don't want to make a big transaction because it might go down or up or crazy. But that's where it is. Once it's a widespread medium of exchange, then it can become the fundamental unit of account underlying all of these. I think fiat currencies or some other like currency types will exist in the future for sure. But I think Bitcoin will be that like global neutral reserve asset on which economic calculations eventually do get based. And we're talking decades. We're in the early innings here. We just got out of the collectible stage, but that's the order of operations that I would see it going in.
I'd argue Russell Okun wants to get his Bitcoin in out of his paycheck. I know he's big in Bitcoin Twitter. And for those that don't know or aren't as big into sports, he's an offensive lineman for the Panthers, a longtime football player. I think he's been in the league 13 or 14 years now. But he's a big Bitcoin guy. And the community loves him because he's like the first, you know, outside of like Elon Musk joking about it, he's like the next biggest celebrity, so to speak, outside of the financial world that's like really big into Bitcoin. And he's a really cool dude to listen to on Twitter. And even a couple of his interviews that I've watched are really cool.
Yeah, he's the man. And I'm just going to shill Strike real quick. So Strike is the application founded CEO Jack Mallers, who's native from Boulder, Colorado. He built this application where your bank now speaks Bitcoin. So like you can take money out of your bank and you can send it to anyone, anywhere in the world, and it gets converted into Bitcoin and then makes the transaction to Australia. And then it gets converted into the Australian currency, and then it gets deposited in your Australian friend's Strike account. And that's kind of like a way to use the current fiat system and like sneak Bitcoin in the background as the payment rails. And that's how it could like become more of a medium of exchange. And Russ is using it right now. So his paycheck gets deposited directly into his Strike account, and immediately upon the paycheck being deposited, 50% of that paycheck gets converted into Bitcoin. And when you're getting paid, what is it, $12 million per year or $6 million?
I think his contract was like 13 million or something like that.
Yeah. So then he's got 6.5 million as dollars. And then if Bitcoin goes down, it doesn't matter as much what the other half of his paycheck does. But as a store of value play, and if I had that much money, I absolutely would be using the same thing. I'm probably going to sign up for it pretty soon myself. But
I'm already in the app. I got approved for the wait list, but it's not in my region yet, which is really unfortunate.
Okay.
But it's exciting, right? Like this is what I wanted to ask it's sort of a few loaded questions. Is it possible for this like order of operations to sort of be homogeneous and harmonious in a sense where you've got a store of value, but you're transacting? Like this is uniquely different from gold. Like I can't remember the last time I gave Chris a gold bar. It's been a while. But the difference between that is we can use Bitcoin because it's so much more than simply I have a Bitcoin where it's like a Chuck E. Cheese coin. It's like I have Bitcoin, which is a store of value, but it's also a medium of an exchange, and it's also a ledger of truth. There's a lot in this technology. Like, is there, from your perspective, any risk of this cycle overstepping one step or the other, or do you see it kind of happening all at once, just in different speeds?
Yeah, I mean, I don't really see any risk in like it becoming more of a medium of exchange. So Bitcoin processes $63 billion worth of transactions per day right now, volume on chain. And the transaction fees are negligible, $10 to $20. If it's it's all about the data size. It's not about the number of Bitcoin you're sending. So that's a little bit more complicated. I don't want to go into that right now, but ultimately the block reward is going to go down. The number of Bitcoin that the miners are getting for mining is going to go down, and it has been going down. Every 4 years, gets cut in half in a process called the halving, and transaction fees go up. And so it will be more and more complicated for people to buy a cup of coffee with Bitcoin already, I would say. I mean, the tax laws are not super, every single Bitcoin transaction is taxable by the IRS, right? So you have to pay sales tax and you have to pay capital gains tax on that transaction if you want to spend your Bitcoin on something. So those are not very friendly to it being a medium of exchange right now, but that doesn't prevent it from actually becoming that in tangent. But I do think the store of value is the primary narrative right now, and that's what's driving this bull cycle. But the Lightning Network is a layer 2 on top of Bitcoin. Bitcoin is ultimately going to be, the transaction fees are going to be ridiculously high in 20 years. And it's going to be a settlement layer between giant corporations or like high net worth individuals, or central banks potentially will be onboarded onto this network, and they'll be using on-chain transactions on the most secure payment network that has ever existed. Mm-hmm. And then other people will be using the Lightning Network, or, the Lightning Network hasn't fully proven itself to the level that Bitcoin has. Maybe another different layer 2 will be built on top of that, the Bitcoin protocol, and whatever that will be what you use for your Visa card transactions. That'll be what you buy your coffee with. That stuff's still in development now. It's really cool. Strike, what Jack's doing with that is really, really cool. And I can see that growing alongside this store value. But for now, I think the store value narrative is the main driver.
Got it.
Yeah, definitely. I guess, or what was I going to go with that? Drawing a blank now. I guess I'll continue on to the next point. So obviously we've used many different things, whether it's pegging fiat currency or just different things in history, whether it's cattle, I give you cattle for your crops or whatever it may be. And obviously all of those have broken down from one way or another. Obviously, food doesn't last, so it's not very durable in that regard. We used gold for a long time, but then even with gold being used, I know kind of you brought up before that there's a big difference between basically collector gold versus what the central banks have. And we've seen issues with, even JP Morgan Chase got fined just in 2020 with basically doing fraudulent transactions. Basically, they were trading futures contracts of, imagine, we'll use me and Ben as an example. So I say, I'm going to buy a futures contract of gold where right now it's trading at, last time I checked, it was like $1,800 for $1,800 per troy ounce. If I were like, hey, Ben, I'm going to buy, gold for $1,000 troy ounce. And the market says, hey, wait a sec, there's all that you have to buy at 1,800. But then all of a sudden, Ben is another JP Morgan trader and accepts that and says, oh, no, I'll take that contract. And they're like, hey, I want to buy more at 1,000. And then Ben accepts that. But if we're doing it internal as JP Morgan traders, that's basically how you can drive the price down. And it's basically, it's fraud. It's illegal. What they did, they got caught. I don't know what happened to the traders themselves, but I know the bank, it was like a $927 million fine, which in the grand scheme of how much money they make is pretty much a slap on the wrist. I don't know if the traders themselves are going to see jail time or be prosecuted by, for the individual people, that could be a much more detrimental trial and what ends up happening to them. But I know for the corporation as a whole, nothing really is going to change. Obviously, hopefully they won't do it anymore, but slap on the wrist in terms of monetary. But so I guess, how do you see Bitcoin not getting debased or people, trying to take advantage of it? Do you see that potentially happening, or how do you see it as a hard sound money that we won't be, this is the new gold in 50, 100 years from now?
So I think that there's two things. I mean, primarily it's the decentralization. So the reason that we're in this cycle of throughout history where every single time we build a great empire on a sound monetary base, and then ultimately there's natural market cycles, whether it's fiat currency or sound money. I would argue that with fiat currency, those natural market cycles are exacerbated to be far above and below the norm, what they should be. But there's going to be a bust cycle, and there's going to be pain, and there's going to be insolvency. And there's always the temptation, if the monetary system is fully centralized behind an authority, there's always the temptation to just remove the pain from the present at the cost of the future. That's Rome clipping their coins to pay the soldiers. That's, like the debasement of the currency in 2008. The banking system went bust, and that would have been very painful. And we developed this concept of something that is too big to fail. And we caved into we should just print as much money as we can, recapitalize the banks. No one gets unemployed. We're good to go. We'll worry about this in 10, 15, 20 years. And because Bitcoin is decentralized, the rules cannot change. And the first thing that Satoshi did, or the single best, greatest invention that he solved in computer science, because people like Nick Szabo, Adam Back, the cypherpunk community as a whole, the cypherpunks are hackers that believe in using the power of technology to empower the individual and grant more defenses and sovereignty to the individual. And they've been working on this digital currency cash type solution for many years, but they couldn't ever solve the double spend problem, right? So the internet created abundance, like infinite copies, BitTorrent, infinite copies of every single piece of music on the internet, infinite copies of PDFs can copy infinitely, stored. How do you prove that
Pictures, yeah.
Pictures, like
my old LimeWire account.
Yeah.
Exactly.
Sorry, FBI.
So that's incredible, and that produced a bunch of abundance for other people. But what Satoshi invented was digital scarcity, and that's how do you prove that you are the only owner of a single Satoshi or Bitcoin unit of a Bitcoin, and that nobody else has it, and that nobody can copy it and create more. He did that by solving the double spend problem, and it's basically the Byzantine generals problem, which is how to achieve consensus on a network where no individual can be trusted. Even if it's like your boy, you trust your boy on the other end of the computer. There could be a hacker in between the protocol call between you two that could be completely mixing the signals. And even if your friend says X, they're going to send you Y. And there's no way to achieve consensus between a bunch of disparate groups that don't trust each other until Satoshi applied proof of work, which was invented by Adam Back with Hashcash and used to solve like email spam. And that's how the mining works. So the mining works every single 10 minutes, a new Bitcoin block is mined. And in that block is all the data for a bunch of transactions, up to 1 megabyte of data. And there's different ways to scale it to be a little bit more. We can talk about those later, but up to 1 megabyte of data, there's all the transactions. And the person who gets that block, it's basically a lottery that's won every single 10 minutes. And the way that you buy a lottery ticket is by putting a bunch of energy into your system to run the same encryption algorithm, in this case, the SHA-256 encryption algorithm, over and over and over again until you get the right answer. You're brute forcing a password, basically. You're brute forcing the answer. Something that a computer could do very well, but a human would take millennia to try to write this out and brute force it. And so basically it's like, how do you know that the person who gets to write to the ledger isn't colluding with somebody else or being threatened? And it's like, okay, well, let's make it a lottery. So nobody knows who's going to win. And it's every 10 minutes. So they're probably not being threatened. They're probably not colluding with anyone because they didn't even know they were going to win in the first place, and neither did anyone else. And then you're like, okay, well, how do you incentivize that person to act in the best interest of the network? And that's what the block reward and the transaction fees come in. If that person who ends up winning the lottery tries to do a double spend or tries to like give themselves more Bitcoin from the protocol, all of the consensus of full nodes that are run all over the world, and there's tens of thousands. It's very hard to calculate because most people run their full nodes behind a VPN, but there's tens of thousands of public full nodes. There could be 100,000 full nodes. We don't know. They are what actually broadcasts that the miner won the new block and broadcasts all the transactions all throughout the network, and it propagates like this like growing, spreading thing as it bounces around and reaches all the full nodes. There's the Blockstream satellite that's going around the earth. You can sync a full node and send a Bitcoin transaction from Antarctica with no internet connection if you just have enough energy to sync with the satellite. And so that's how you solve the double spend problem. It's like every single actor has to put a ton of energy and a ton of real world cost into buying these lottery tickets. So they have a bunch of sunk costs. So if they then do win the lottery, they've already have all this sunk cost. They're incentivized to be honest actors by actually updating the blockchain with the appropriate transactions, whichever transactions give them the highest mining fees. And with valid transactions based on the consensus rules. You know, like I have to send a Bitcoin to Ben, and I'm not allowed to send that to Ben unless I have a Bitcoin and Ben is giving me a valid address, right? And then with the block reward, every single time a block is mined, there's 6.25 Bitcoin that are rewarded, 6.25 Bitcoin that are rewarded to the miner. And if they try to make that 10 Bitcoin, that's invalid. If they try to make it 5, that's invalid. It's got to be 6.25. So that's basically how the decentralization works. That's how the protocol ensures that even if there's hardship or pain, we can't change the rules. And there will be other systems in place. Like I said, I think Bitcoin will be more of like a reserve asset in the future, or maybe eventually it'll be the only thing that exists. But for now, it's just this separate thing, and it can't be debased, and the rules can't be changed. So that is the basic of the technology. There's also the difficulty adjustment. So I said that a block gets mined every 10 minutes. How is it ensured that a block gets mined every 10 minutes? So if the price of Bitcoin were to go to $2 million per Bitcoin tomorrow, you can be sure that tons of people would start mining Bitcoin from their computers or whatever it is, and there's specific hardware that makes it best, but so many miners would come online. Every miner that's mining any other blockchain would come online, and suddenly Bitcoin blocks would begin to get mined at faster than 10-minute rate. But every 20,016 blocks, which is approximately 2 weeks if you give it a 10-minute per block time period, the difficulty adjustment adjusts so that if the blocks were getting mined over that last 2-week period, if they were getting mined at faster than 10 minutes, it gets harder. You need more lottery tickets to win the lottery and actually mine the block. And if they were getting mined slower, it gets slower. And that's another aspect. That's like one of the beautiful things. It's self-adjusting. If the price goes up, the price goes down. It's every 10 minutes. And then there's the halving every 4 years, every 210,000 blocks. It gets cut in half. That Bitcoin reward will get cut down to 3.125 Bitcoin in the year 2024, every 4 years after that until the year 2140, where the 21 millionth Bitcoin will be mined.
Yeah.
It's exciting. And honestly, I think you said it aptly, that it is beautiful. Like this is, and I think we're going to start getting wrapped up because we're nearing the end of the time, but it's a beautiful technology that is uniquely different from gold when you think about it. Like those miners are not incentivized to be honest actors, right? This technology was built and communalized, if that's even a word, on veracity. It becomes more robust the more truth that's plugged into the network, and the miners are incentivized to basically tell the truth together, and have this protocol that is abided by better than any law that I think has ever been passed. And I think that's a pretty incredible technology. So Jimmy, thank you so much for the explanation on this. So this was such an excellent conversation. First of all, Jimmy, thank you so much for being on this show.
Thank you for joining us.
We're going to wrap up this part of the episode. We're going to dive a little bit more deeply into, some current market conditions, a little bit more on the technology side of things, and then how to get started buying Bitcoin. So guys, stay tuned for next week's episode, and thanks for watching. Have a great week.
Catch you later, guys.